Right now, millions of shares of some of the most famous companies in the world are changing hands on Wall Street.
Oh, yeah. Billions of dollars just moving from one side of the ledger to the other.
Exactly. But in a few specific, honestly terrifying cases, the price of the stock isn't moving an inch. It's mathematically paradoxical, right?
Totally. You have this massive kinetic energy, a veritable hurricane of buying and selling.
And yet the ticker sits perfectly,
Hmm.
impossibly still. It's happening right in front of us, just hiding in plain sight.
Right. It's the ultimate illusion of equilibrium. I mean, when you see that kind of massive volume without a corresponding price swing, retail traders tend to assume, the stock is just boring today.
Yeah, they just pass right over it.
Exactly. But what's actually happening in the dark pools and the level 3 order books is this high stakes algorithmic standoff.
And that standoff is exactly what we are tearing apart today. Welcome to the deep dive. I want you, the listener, to orient yourself right now. It is Monday, May 4th, 2026.
And the closing bell has just rung.
Right. The closing bell just rang. The financial networks are currently broadcasting their standard wrap-ups, talking about macroeconomics and consumer sentiment.
Yeah.
And we are going to ignore all of that.
Completely, because, the evening news narrative is always trailing the actual money by at least 24 hours.
Oh, at least.
Yeah. We're looking at the raw mathematics of the closing bell before human emotion has time to write a story about it.
Right. And to do that, we have our hands on a highly exclusive, honestly incredibly dense stack of data. We are looking directly at the top 100 volume S&P 500 closing market data.
And this isn't just any data pull.
No, this is provided explicitly by the IntelliTrader's AI team, managed by Sadeh Bayrami. This isn't a list of who had a good earnings call. This is a surgical cross-section of institutional order flow.
Yeah, because Sadeh Bayrami's team, they operate on a completely different philosophical plane than traditional analysts.
Right, they don't care about the news.
Exactly. The IntelliTrader's AI doesn't care who the CEO is. It doesn't read press releases. It tracks the physical footprint of capital, specifically how aggressively buyers are attempting to acquire shares versus, how defensively sellers are retreating from the ask price.
Which brings us to our mission for today.
Yeah.
We have all this May 4th closing data, and our objective is to use the IntelliTrader's AI's aggressively strict criteria to hunt for the perfect stocks.
The absolute perfect ones.
Yeah, we are building a new portfolio for you today. But to make it into this portfolio, a stock has to clear what is basically a nearly impossible hurdle.
It's a gauntlet. We are hunting for anomalies here.
We are hunting for the holy grail of AI signals. The criteria is set in stone. First, we need high volume, specifically what the AI calls a sizzle index.
Right, which means a volume ratio over 100.
Exactly. Second, the stock must be flagged as UV or undervalue on both its weekly and daily charts.
And then there's the third one.
Yeah, the ultimate trigger, the spark in the powder shake, basically. Weekly and daily buyer up, seller down momentum.
Which is so rare to see perfectly aligned.
It really is. And according to the IntelliTrader's AI, when these specific conditions lock in simultaneously, the price will go up. It ceases to be a probability and becomes a mechanical certainty.
It's just math at that point.
Okay, let's unpack this. Because terms like undervalue and volume ratio over 100 get thrown around on financial television every single day.
Oh, constantly. It's buzzword soup.
Right. But I suspect the IntelliTrader's AI is using a vastly different dictionary than the guy shouting on a trading floor. So before we look at a single stock, we need to understand the tools.
We have to define the mechanics.
Exactly. How is Sadeh Bayrami's team defining UV, undervalue, and OV, overvalue, in this specific data set? Because clearly this isn't about price-to-earnings ratios or, discounted cash flow.
Not even close. Traditional undervalued metrics rely on the company's balance sheet, right?
Yeah.
Assets, liabilities, projected revenue.
The fundamental stuff.
Right. That's fundamental analysis. The IntelliTrader's AI is performing dynamic, real-time microstructural analysis.
Okay, so what does that actually mean for the UV and OV tags?
Well, in this data set, UV and OV are measurements of the stock's immediate price action relative to the localized buying and selling pressure inside the order book. And I mean right at this very microsecond.
So you're saying it's purely about the mechanics of the bid and the ask.
Exactly.
But wait, how does an AI look at a bid-ask spread and declare something overvalue if people are willingly paying that price? If I buy it for $20, isn't it worth $20?
You would think so, right? But it's because the AI measures the rate of decay in the order book. Let's say a stock is flagged as OV, overvalue.
Hmm.
The AI has detected that the current price is climbing, but the actual depth of buyers willing to support that new higher price is thinning out.
Oh, so the momentum is superficial.
Right. The algorithms are tracking limit orders. When a stock is heavily OV, it means the price has outpaced the starvation of demand. Retail might be buying at the market price, pushing it up. But the institutional limit orders the massive walls of money that actually dictate long-term price stability that are being canceled.
Or they're being pulled downward.
Exactly. The foundation is rotting even while the penthouse is being built.
Wow, okay. That makes the UV, undervalue, flag much more interesting. If UV is the opposite, it means the price on the ticker is artificially low compared to the sheer mass of institutional limit orders crowding the bid.
Yes.
Like the foundation is aggressively rising, but the penthouse hasn't caught up yet.
That is exactly the right way to visualize it. The underlying momentum justifies a significantly higher price than what the current last traded print actually shows.
But the value flag alone doesn't trigger the IntelliTrader's buy signal, right?
Yeah.
We need the momentum mechanism too.
The buyer up, seller down flag.
Right. Now, on the surface, more buyers, fewer sellers sounds like economics 101. But how does this AI specifically quantify seller down? Are people just deciding not to sell?
It's much more active than a passive decision not to sell. Seller down means the liquidity resting on the ask side of the order book is literally evaporating.
Evaporating, like they're deleting their orders.
Imagine looking at a ledger. Sellers post their shares at $50.01, $50.02, $50.03. When the AI triggers a seller down flag, it is mathematically observing those resting sell orders being canceled by the thousands.
Totally unexecuted.
Completely unexecuted. The sellers are actively retreating higher up the chain or removing their supply entirely.
So the sellers are pulling their inventory off the shelves because they know a rush is coming.
Exactly. And at that exact moment, the AI is looking for buyer up.
Okay, so buyer up means what exactly? Just more market orders.
Yes, but more than that, buyer up means the rate of incoming market buy orders is accelerating, and the resting limit buy orders are creeping upward.
So the buyers are getting desperate.
Right. You have aggressive demand actively consuming a vanishing supply. When a highly accelerating force meets a completely vacated resistance zone, the math dictates an upward price explosion.
And that leads directly to the concepts of the sizzle index and daily squeezing. Right?
Yep, they go hand in hand.
So the sizzle index is driven by the volume ratio. If a stock averages, say, 10 million shares a day, and today it trades 20 million, that's a 200% volume ratio.
Which is huge.
Right, that's your sizzle. But I want to avoid the typical pressure cooker analogy here. It feels too simplistic for what the IntelliTrader's data is showing us.
Yeah, it's a bit cliche.
If we look at market microstructure, it feels more like a hydroelectric dam. The volume, all those millions of shares, is the raw water pressure sitting behind the wall. The sizzle index is the floodgates suddenly opening, pushing double or triple the normal capacity through the system.
Oh, I like that.
And the daily squeezing, that buyer up, seller down momentum, is the intake valve, perfectly capturing that kinetic energy and converting it into violent upward price action.
What's fascinating about that dam analogy is that it perfectly captures the risk of the OV flag, too.
How so?
Well, if you open the floodgates, so you have a massive sizzle index, but the intake valves aren't structurally sound. Basically, if the stock is overvalued and the buyers are exhausted.
Oh, the water just destroys the infrastructure?
Exactly. The price collapses under the weight of its own volume. You need the sizzle index, the UV value, and the buyer-seller momentum aligned to successfully generate the power.
But wait, if the sellers are actively pulling their orders away and the buyers are just aggressively bidding in a vacuum, doesn't that create a fragile price floor?
It can seem that way, sure.
Like, are we just riding a localized algorithmic wave, or is the AI actually sniffing out real fundamental value that the rest of Wall Street missed at the 3 p.m. close?
To the AI, the difference between algorithmic momentum and fundamental value is purely chronological. The algorithm is simply reacting faster.
What do you mean by that?
Well, think about it. Why do massive institutional algorithms suddenly create a buyer-up, seller-down vacuum on massive volume? They don't do it for fun.
Right. It costs millions.
Yeah, exactly. They do it because their proprietary models realize the company is fundamentally undervalued based on data the broader market hasn't priced in yet. Sajid Bairami's AI isn't reading the company's balance sheet. It is reading the aggressive physical footprints of the trillion-dollar funds that did read the balance sheet.
So it's essentially a meta-analysis. It's letting the smartest, most capitalized players in the market do the fundamental homework, and then the AI just measures the speed at which they are quietly executing their trades.
Precisely. By the time the fundamental news breaks on television, the daily squeeze has already happened. The IntelliTrader's AI captures the rotation in the dark.
Okay. With the mechanical lens established, we need the sizzle index floodgates open, the undervalued structural support, and the momentum intake valves aligned. We can finally look at the May 4th closing data.
Let's get into the numbers.
We need to look at the loudest, hottest volume stocks on the market today. But as this data makes terrifyingly clear, following the crowd into high volume is the fastest way to get slaughtered if you ignore the value flags.
Yeah, the primary utility of an advanced AI isn't just telling you what to buy, it's aggressively warning you what to avoid when human FOMO, that fear of missing out, is at its absolute peak.
Which brings us to the sizzle index breakers. We are looking at the heavyweights dominating the volume charts today, but the AI has flagged them entirely as OV, overvalue. These are the traps.
The value traps, exactly.
First up, INTC, Intel Corporation. The numbers here are genuinely staggering. 119.2 million shares traded today.
That is massive volume.
It is. It boasts a volume ratio of 150%. So it is trading 50% above its already massive daily average. It's got the heat. And look at the momentum. It shows buyer up in the first two columns.
Right, which looks incredibly bullish to the untrained eye.
Exactly. If I'm a retail trader, I see 120 million shares moving and buyers aggressively stepping up. My instinct is to jump in instantly. But the IntelliTrader's AI has flagged Intel entirely as OV. 150% OV on the first metric, 98% OV on the second, 107% OV on the third.
What's fascinating here is, well, if we break this down, the AI is illustrating a classic distribution phase. A human sees 119.2 million shares and buyer up and assumes it's a rally.
Because of the price is green, right?
Right. But the AI looks at the level 3 order book and sees that while buyers are aggressively hitting the ask, the underlying limit orders, that structural support, is decaying. The 150% OV flag means the rate of bid replenishment is completely failing to keep pace with the price.
So you're saying the retail buyers are aggressively buying market orders, feeling great about the green numbers, while the institutions are quietly and efficiently offloading 120 million shares directly into that retail demand.
That is the exact definition of institutional distribution. The daily squeeze already happened, likely hours ago or even days ago. The pressure valve has blown.
Wow. So buying Intel at the 3 p.m. close today?
Despite the massive volume, it carries an astronomical risk of buying the absolute top. The moment retail runs out of capital to keep hitting that buyer up button, the price will experience an air pocket. It'll collapse down to find true structural support, which the AI says is drastically lower.
That dynamic is terrifying when you apply it to the rest of the semiconductor sector today, because Intel is not an isolated incident in this May 4th data. Look at MU, Micron Technology.
The numbers on Micron are wild.
46 million shares traded. The sizzle index, the volume ratio, is a mind-bending 490%. It is trading nearly 5 times its normal volume.
5 times.
And it shows buyer up across the board. But again, it's flagged as an extreme 490% OV.
Yeah, 5 times normal volume is a catastrophic level of algorithmic heat. That is a frenzy. And Sadeh Bahrami's AI is staring coldly at that frenzy and printing a giant red stop sign.
Just screaming at you to stay away.
Exactly. A 490% overvalue flag combined with a 490% volume ratio means the current price action is a total anomaly. It is a localized, unstable bubble fueled entirely by late-arriving liquidity.
And it gets worse. WDC Western Digital. The absolute volume is lower at 10.1 million shares, but the sizzle index is an astronomical 969% volume ratio.
Almost 10 times the normal volume.
Almost 10 times. Buyer up across the board. Completely flagged as OV, 969% OV, 66% OV, 46% OV. And then we have AMD, Advanced Micro Devices. 42 million shares, 256% volume ratio. Also flagged completely OV.
It's sector-wide.
Yeah. If we look at this sectorally, Intel, Micron, Western Digital, AMD, the human financial narrative for May 4th is undoubtedly semiconductors are experiencing a massive supercycle. Buy everything.
And the AI's data is screaming the exact opposite. It is identifying a highly coordinated sector-wide blow-off top. The smart money is using the massive retail buyer-up momentum to exit their positions at highly inflated overvalue prices.
So they're cashing out.
Yeah. If we are building a structurally sound new portfolio for you right now, this data is invaluable because it tells us exactly where the institutional capital is leaving.
It's an incredible lesson in algorithmic discipline. We have to actively ignore the shiny objects dominating the ticker tape. So if the AI rejects the loudest, highest volume tech stocks, we have to pivot. Where does it find actual value?
We apply the strict UV undervalue filter.
Right. We're leaving the distribution traps behind and hunting for the golden geese. The stocks where the AI has mathematically proven that the localized scarcity is real and the daily squeeze is imminent.
This is where we demand perfection from the data. We still want that sizzle index over 100 to prove there is unusual institutional interest.
Of course.
But we demand the undervalue structural support, and we mandate the exact buyer-up, seller-down momentum.
Let's pull the first target from the IntelliTrader's data stack. TTD, the trade desk. The closing price today is $24.10.
Yeah.
Volume is 12.3 million shares. It boasts a massive 236% volume ratio.
That's a huge sizzle index.
It is incredibly hot, trading well over double its normal volume. Crucially, the AI explicitly flags it as UV, 236% undervalue on the first metric. And the momentum columns are the exact pressure cooker recipe we talked about. Seller DN, buyer up, buyer DN.
Dissecting TTD gives us the perfect IntelliTrader's blueprint. First, the 236% sizzle index confirms institutional presence. 12.3 million shares of a mid-cap tech stock do not move by accident.
Yep, that's targeted.
Second, the 236% UV flag confirms that despite this massive influx of volume, the price hasn't exploded yet to match the incoming capital. The algorithmic intake valves are holding the pressure.
But it's the sequence of that momentum that proves the mechanism, isn't it? Seller DN followed by buyer up.
Yes. The sequence is the mathematical fingerprint of a squeeze. First, seller DN. The algorithms detect that the resting limit sell orders are vanishing. The ask is thinning out.
So the people who own it are pulling their sell orders.
The institutions holding the trade desk refuse to sell at $24.10. Immediately following that evaporation of supply, we see buyer up. New, aggressive market buy orders slam into the thinned-out order book. When aggressive buying hits a vacuum of selling, the price trajectory is violently steep.
Here's where it gets really interesting for me. When I dive deeper into the extended IntelliTrader's data for TTD, it carries a 95% right implied flag in a trailing column.
Yeah, the historical context flag.
Based on the mechanical logic we're applying, this implies the stock has been severely battered on a macro time frame. It has been pushed down relentlessly. And yet, right here, right at this specific $24.10 price point, the AI's volume sensors and localized momentum flags are triggering the ultimate buy signal. It is mathematically identifying the exact bottoming of the order book.
That is the greatest advantage of an emotionless model. A human trader looks at a 95% unchart and feels intense physiological fear. They see a falling knife.
They don't want to catch it.
Exactly. But the IntelliTrader's AI ignores the historical chart pattern entirely. It looks purely at the active live order book today, May 4th, and it calculates the historical sellers have exhausted their inventory. Fresh institutional buyers are crossing the spread with double the average volume. The mathematical equilibrium demands a higher price.
It doesn't feel fear.
No, it only processes the localized scarcity.
Okay, so TTD is absolutely locked as a first anchor in our new portfolio. It has the volume, the UV, and the perfect momentum cross. Let's look at another golden goose the AI flagged. BX Baxter International.
Oh, this is a great one.
Price is $16.62. Volume is 7.4 million shares. The volume ratio sits at 127%, comfortably clearing our sizzle index threshold. It is cleanly flagged as UV on the primary metric, 127% UV. The momentum reads seller DN, seller up, and it also carries a 54% unique historical flag.
So Baxter presents a slightly different flavor of the same mechanical setup. The unusual volume is present at 127%. The value metric is screaming undervalue, but the momentum sequence requires careful analysis here.
Right, because it's not identical to trade desk.
No. We have the initial seller DN flag. The immediate supply, the closest resting limit orders, have dried up. But we don't have the aggressive buyer-up market orders hitting the tape like we did with TTD. Instead, we see seller up.
Wait, if we have seller up, doesn't that mean supply is re-entering the market? How is that a buy signal?
Well, seller up in the secondary columns, when combined with a primary seller bean and a massive UV flag, often indicates that sellers are moving their limit orders to higher price brackets.
Oh, I see.
They aren't flooding the current $16.62 price with supply, they were retreating to $17 or $18, just waiting for the buyers to come to them.
So they're basically retreating to higher ground.
Exactly. The sheer exhaustion of immediate selling pressure, structurally protected by the UV flag, creates a slow-burning upward drift. It's a less violent squeeze than TTD, but an incredibly high probability value accumulation.
That makes perfect sense. The sellers are giving up ground without a fight. So Baxter is a highly stable, structurally sound addition. What about CAG, Conagra brands?
Another solid consumer play.
Price $13.85. 12.7 million shares traded. The volume ratio is 105%, so it just clears the sizzle index. But it is flagged immaculately as UV across all time frames. 105% UV, 13% JED, 7% UV.
Conagra is your undeniable rock-solid value play in this data set. It doesn't have the explosive 236% sizzle of the trade desk, but it has the prerequisite institutional volume.
Right, over 12 million shares is nothing to sneeze at.
Exactly. What makes CAG compelling for a new portfolio is the absolute consistency of the UV flags across the short, medium, and longer-term intraday structures. The AI is confirming that on every single algorithmic time frame, Conagra is underpriced relative to its active order flow. It represents incredibly low structural downside risk.
Okay, so we've extracted some phenomenal mid-cap and consumer staple targets. The Trade Desk, Baxter, Conagra. But if you're listening to this and assuming that Sadeh Bahrami's IntelliTrader's AI is only useful for finding inefficiencies in smaller, less liquid stocks,
they would be very, very wrong.
Yeah, this is where the May 4th data gets genuinely shocking. It is not just the mid-caps showing these extreme UV squeeze signals. We are seeing the exact same localized scarcity metrics in the absolute titans of the S&P 500.
This is where the methodology proves its scale. Finding a temporary pricing inefficiency in a $13 stock trading 12 million shares is one thing. Finding a massive algorithmic imbalance in a multi-hundred billion-dollar megacap requires an entirely different level of computational power.
Let's prove it with the data. TSLA, Tesla. The closing price today is $392.51. The volume is an immense 48.7 million shares.
That's a staggering amount of capital moving.
Intuitively, any human trader looks at a nearly $400 stock with almost 50 million shares changing hands and assumes the market is perfectly efficient. There is simply too much liquidity for the price to be wrong. But look at the AI's output. Tesla is heavily flagged as UV across the board. 10% UV, 2% UV, 2% UV.
And look at the momentum.
It flashes the absolute golden sequence. Seller in, buyer up, seller in. How does an algorithm look at a $392 mega cap and declare it undervalue? Is the AI's definition of value absolute, or is it just relative to that specific day's order flow?
If we connect this to the bigger picture, this is exactly why we had to redefine UV and OV at the start of this deep dive. The AI doesn't care about the nominal $392 price tag. A share price is just a label to the AI.
Right, there's just a number on a screen.
Exactly. The AI cares about the ratio of active kinetic capital to resting limit order supply. For TSLA, the AI has calculated that the 48.7 million shares absorbed today were bought with such aggression and the sellers retreated with such speed that the mathematical equilibrium of the stock requires a massive repricing upward.
And the seller Dean, buyer up, seller Dean momentum proves it mechanistically.
Absolutely. Think about the capital required to trigger a seller Dean flag on Tesla. We are talking about billions of dollars worth of institutional supply suddenly vanishing from the ask. Retail traders cannot create a seller Dean signal on 48 million shares of a mega cap.
No, they just don't have the firepower.
That is algorithmic exhaustion. The massive funds have finished distributing, and immediately we see buyer up. Aggressive institutional accumulation taking over. When the big money stops selling and simultaneously starts aggressively buying, it creates a mega cap daily squeeze.
It's the hydroelectric dam again, but the reservoir is the size of an ocean. Let's look at another titan. MSFT, Microsoft. Price is $413.62. Volume is 28 million shares. Another behemoth. And again, flagged entirely as UV by the AI. 2% UV, 3% UV, 1% UV. The momentum is crystal clear. Seller DN, buyer up, buyer up.
Microsoft is painting the exact same microstructural picture as Tesla. The sheer weight of the capital shifting stance here is awe-inspiring. The IntelliTrader's data is essentially giving us X-ray vision into the dark pools at the closing bell. The institutions are done selling Microsoft, and they are aggressively crossing the spread to accumulate.
We have to bring SMCI supermicrocomputer into this mega-cap tech discussion.
Oh, this is a fascinating contrast.
The nominal price is lower at $27.92, but it is trading 29.3 million shares. Massive volume. And the AI flags it heavily as UV on the primary metrics. 66% UV, 14% UV. The momentum reads, seller DN, buyer NDN, buyer up. Now wait a minute. SMCI is deeply entrenched in the exact same AI hardware ecosystem as Intel, Micron, and AMD.
The ones we just said were massive traps.
Exactly. We just spent 20 minutes discussing how that entire semiconductor sector is an overvalued blow-off-top trap. Why is SMCI flashing heavily undervalued with sellers stepping down?
This is why you cannot trade broad sector narratives. The human narrative says buy all chips or sell all chips. The IntelliTrader's dataset is entirely surgical. It dissects the sector.
So it's looking at SMCI completely independently.
Right. While Intel and AMD are experiencing massive algorithmic distribution and retail exhaustion, SMCI is sitting there with a 66 per 6 per CUV flag because its specific order book dynamics are entirely different. The institutions are dumping Intel, but they are holding or quietly accumulating SMCI. The AI detects the lack of selling pressure, that's the seller DN, and the underlying structural value.
It's a completely isolated value pocket within a heavily distributed sector. That is brilliant. So for our new portfolio, we are confidently adding Tesla and Microsoft. And we aren't doing it because we love the brands. We're doing it because the raw, unemotional mathematics of their order books demand it.
We follow the math.
Always. But while the financial media is obsessing over megacap tech today, the IntelliTrader's AI volume sensors have picked up an incredibly massive, almost silent rotation into a completely different sector.
And when you say silent, you just mean in the media, right?
Yeah, because the volume numbers here are genuinely deafening.
This is perhaps the most actionable, high-level insight buried in the entire May 4th dataset. When retail is getting trapped at the top of the semiconductor bubble, the smartest money on Wall Street is quietly executing tidal wave levels of volume somewhere entirely unglamorous.
You aren't kidding. Let's look at the data for NCLH, Norwegian Cruise Line. The closing price is $17.20. When I saw the volume figure on the IntelliTrader's report, I actually thought it was a typo.
I don't blame you. It's an insane number.
The volume is an astronomical 58.8 million shares. Nearly 60 million shares of a physical cruise line changed hands today. It is strictly flagged as UV across all three metrics, 33% UV, 34% UV, 16% UV, and the momentum is unequivocally locked, seller D and seller D and seller up. What is the mechanical reality of 60 million shares moving in a single day in a distressed consumer stock?
The mechanical reality is total capitulation and immediate, massive institutional absorption. These aren't high-flying, speculative tech assets. These are capital-intensive legacy businesses.
Right, physical ships.
Exactly. When you see nearly 60 million shares of a cruise line move with a triple UV flag, the AI is screaming that a massive macro rotation is occurring.
But the key is that double seller Dean momentum flag.
Exactly. The seller Dean means the capitulation is over. Anyone, retail or institutional, who wanted to exit Norwegian Cruise Line out of macroeconomic fear has already sold.
They're gone.
They are utterly, completely exhausted. The limit order book on the ask side is barren. Yet 60 million shares were bought. The institutions stepped in, absorbed every single share of that panic selling, and the price remained deeply undervalued according to the AI.
So what does this all mean for you, the listener, trying to build a resilient portfolio? You don't absorb 60 million shares quietly unless you were building a massive position before a major repricing event.
Right. But remember, the AI doesn't know why they are buying. It doesn't know if there is unreleased data on summer travel bookings or a quiet debt restructuring.
It doesn't care.
The narrative is irrelevant. The mathematical truth is that tens of millions of shares were consumed, the sellers vanished, and the kinetic energy is trapped beneath an undervalued ceiling. The price, mathematically, has nowhere to go but up when the broader market realizes the supply is gone.
Let's look at another giant in this consumer recovery space. Ford Motor Company. Price is $11.50. Volume is 51 million shares.
Another absolute behemoth of an absorption number.
Yeah. The AI flags it completely as UV across the board. 11% UV, 22% UV, 11% UV. The momentum shows seller up across the board. Now, this is different from Norwegian. Norwegian had seller Dean, meaning the sellers gave up. Ford has seller up, meaning people are still actively trying to sell their shares at $11.50.
This is still supply.
So why is the AI still flagging this as heavily undervalued if there's still a heavy supply?
Because the 51 million shares of buying pressure is dwarfing that supply. Think of it as an iceberg order scenario. Yes, there are sellers stepping up, placing limit orders to exit Ford, but the institutional buyers are sitting on the bid with such immense algorithmic weight that they are happy happily eating every single share the sellers throw at them.
Like a whale just swallowing everything.
Exactly. And the mathematical equilibrium of that exchange still dictates a higher intrinsic value. Ford is a classic value accumulation play. It's a coiled spring, just a slightly heavier, slower one than Norwegian, because the sellers haven't completely capitulated yet.
And rounding out this quiet consumer rotation, we have NKE, Nike. Price $43.09. Volume is 33.2 million shares. Flagged heavily as UV. 47% UV, 46% UV, 1% UV. It also shows sellers stepping up, similar to Ford, but with that massive 47% primary undervalue flag.
It sits the exact same pattern.
When you synthesize this data, Norwegian Cruise Line, Ford Motor Company, Nike, you see a massive structural pattern that human commentators completely missed today.
The IntelliTrader's data is explicitly telling us to pivot our capital away from the overvalued, overhyped semiconductor space, the Intels and the AMDs, and follow the institutional volume into deeply undervalued consumer staples and discretionaries.
It's the difference between reading the news and reading the order book.
Exactly.
It is a masterclass in capital rotation. We are absolutely locking Norwegian NCLH into our new portfolio. It has the unprecedented 60 million share volume, it has the perfect UV structural support, and it has absolute seller exhaustion.
A perfect candidate.
Okay. We have mapped the entire battlefield. We found our OV distribution traps and avoided them. We captured our golden UV geese like the trade desk.
Okay.
We identified the mega cap tech squeezes in Tesla, and we uncovered the massive consumer rotation in Norwegian.
We've covered a lot of ground.
We have. But as I parse the final pages of this IntelliTrader's dataset, there is one final bizarre anomaly. It is a specific categorization of data that the AI explicitly flagged, and frankly, it kind of broke my brain when I first read the mechanics of it. Let's examine the sideway enigmas.
Ah, yes, the sideway flags. Understanding these setups really separates novice data readers from highly advanced algorithmic strategists.
Right, because if you're listening, you intuitively assume a stock is either experiencing buying pressure or selling pressure. Buyer up or seller down. The price goes up or it goes down.
It's a binary way of thinking.
But Sadeh Bayrami's AI has mathematically isolated a third category, and it is heavily present in some of the highest volume, most liquid stocks in the market today. Let's look at the prime example, PLTR, Palantir Technologies.
The data on Palantir is wild today.
The closing price is $146.03. The volume is a gargantuan 70.5 million shares. But look at the AI's primary flags. It doesn't say UV or OV immediately. It is tagged explicitly with the word sideway, then another sideway, and then finally an 8% UV flag in the third column.
And look at the momentum on that one.
It's the most extreme sequence possible. Celardine, 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 and.
This raises an incredibly complex microstructural question. How does a stock with over 70 million shares in daily volume, an absolute ocean of transactional liquidity trade sideways according to an advanced algorithmic model?
That's exactly where I get stuck. If 70 million shares physically change hands, kinetic energy is being expended. The stock isn't sitting still, it's churning.
It is churning, but it is experiencing a perfect, violent, algorithmic equilibrium. The IntelliTrader's AI uses the sideway tag not to indicate a lack of activity, but to indicate that an immense amount of kinetic energy is being systematically stored without leaking into price discovery.
Wait, stored? How do you store volume?
Instead of a boulder against a wall, think of a central bank aggressively pegging a currency. If a central bank wants a currency to stay at exactly $1, they will deploy algorithms to automatically buy every single fraction of a cent below $1 and sell every fraction above it. They absorb all market chaos to maintain a flat line.
So you're saying institutions are pegging the price of Palantir?
They are using algorithmic dark pools and perfectly matched iceberg orders to absorb 70.5 million shares without tipping their hand to the broader market. They are matching the exact output flow tick for tick. That is the sideway flag. It is the footprint of massive hidden accumulation or distribution.
Okay, but if the AI just sees perfect equilibrium, how do we know if it's a buy or a sell? Why do we care if the price is pegged?
Because of the momentum columns. Celardine, Celardine, Celardine. The perfect equilibrium is cracking on the supply side. The sellers have completely stepped down across every single time frame the AI tracks.
Oh, I see.
The 70 million shares of volume is massive. The sellers have completely evaporated from the limit order book, but the institutional buyers haven't officially broken their own price peg to trigger a buyer-up momentum yet. They are quietly absorbing every last remaining share at $146.03 in the dark.
Wow.
Palantir is the ultimate hyper-compressed spring before the daily squeeze even begins.
Oh, wow. So Palantir might actually be the stealthiest, most explosively dangerous upward pick on Sadiq Bayrami's entire list. The tension hasn't even begun to release. The pressure is just quietly building to catastrophic levels behind that algorithmic peg.
Precisely. When a stock with 70 million shares of volume and absolute zero selling pressure finally breaks out of an institutional sideways peg, the resulting price action is usually violent, instantaneous, and sustained. It's a highly advanced, asymmetric portfolio addition.
Let's look at two more sideways enigmas to confirm this microstructural pattern. AT&T. Price $26.10, 23.4 million shares. Also tagged sideways, but crucially, the third metric is 1% UV. And the momentum shows buyer Dan, seller Dan.
And then there's Meta.
Right, Meta Platforms. Price $610.41, 16.2 million shares. Heavily UV on the first two metrics, 11% UV, 11% UV. But the third metric is flagged sideways. And the momentum is seller Dan, buyer Dan, seller Dan.
Meta and AT&T confirm the exact methodology. Look at Meta. You have a stock that is deeply undervalued according to the AI's primary metrics. But that third sideways flag, combined with the seller-dean momentum, tells us the institutions are in the late stages of the accumulation phase.
So they're almost done buying.
They are building their positions quietly. They explicitly do not want the price to spike yet. They are deploying algorithms to hold the price sideways, accumulating as many of those 16.2 million shares as possible at $610 before they turn off the peg and let the massive undervalue pressure uncoil.
It is market manipulation in its purest, most mathematically optimized form. They are just using the sheer weight of their capital and infinite algorithmic patience to trap the price. And the IntelliTrader's AI just exposes this invisible war plainly on a spreadsheet. It's truly remarkable.
It really is. It changes how you see the market.
Okay, we have unpacked an immense amount of high-level microstructural data for the May 4th closing bell. It is time to pull this all together for you. We set out on a mission to build a new portfolio based strictly on the IntelliTrader's AI criteria, avoiding the human narrative and following the raw mathematical truth of the order book. I think we have found their absolute, undeniable gems.
We adhere to the gauntlet perfectly. We demanded the sizzle index to confirm institutional volume. We mandated the UV flags for structural support, and we hunted for the mechanical collapse of sellers.
To win in this specific market environment, we follow Sadiq Bayrami's logic. Based on everything we've analyzed today, here's the finalized, mathematically optimized IntelliTrader's portfolio. First, TTD, the trade desk.
A classic daily squeeze.
Exactly. 236% sizzle index, massive undervalue flags, and the perfect seller down buyer up momentum. Second, TSLA, Tesla, the mega cap anomaly. 48 million shares, heavily undervalued, with undeniable institutional buyer up momentum proving the smart money is accumulating.
A giant waking up.
Third, NCLH, Norwegian Cruise Line, the 60 million share consumer recovery titan, a massive sectoral rotation play with absolute verified seller exhaustion. And finally, PLTR, Palantir, the ultimate sideways enigma, 70 million shares trapped in a perfect algorithmic holding pattern with zero selling pressure, just waiting for the peg to be pulled.
These four stocks are the hidden structural realities beneath today's closing bell. They are the blueprint.
It is a portfolio built entirely on the mechanics of localized scarcity, not the emotion of the evening news. It is a masterful extraction of signal from the noise.
That's the only way to trade.
And speaking of signal, if you want to keep cutting through the noise with us, make sure you follow our channel to stay updated on this daily market analysis. We will be back to break down the next set of IntelliTrader's data as soon as the closing bell rings.
Can't wait.
But before we let you go today, there is one final mind-bending data point from Sadiq Bayrami's May 4th list that we haven't discussed yet. And I saved it for the very end because it genuinely challenges how we understand the limits of these algorithmic models.
Ah, yes. The true anomaly. The system break.
We analyzed incredibly extreme numbers today, 900% volume ratios, 490% overvalue flags. But look at the data row for SNDK. SanDisk. It closed at an incredibly high nominal price today, $255.86.
And it traded a massive 17.8 million shares at that price.
Right. But when the IntelliTrader's AI went to calculate its primary value metric, it didn't output a percentage. It didn't say 100% OV or the 1,000% OV. The algorithm literally flagged it with a mathematical impossibility. It output the infinity symbol.
Literally just an infinity sign.
Yeah, infinity %.0 OV is the only stock on the entire 100-item data set to completely break the algorithm's mathematical boundaries.
Which is just, it's unprecedented.
If an advanced AI specifically designed to perfectly measure localized buying and selling pressure, looks at the level 3 order book for 17.8 million shares of a stock and calculates its overvaluation as literal mathematical infinity.
Right.
Well, what exactly happens to the market when the underlying math actually breaks?
That is the million-dollar question.
Something to think about. Thank you for joining us on this deep dive. We'll see you next time.